be talking about investments. So our learning objectives for this topic is to classify the investment, look at the accounting aspect of investments that are held for trading, which could either be in debt or equity investments, how to account for investments which flow through profit and loss or the other comprehensive income, amortized cost in debt investment, financial statement representation, significant influence equity investment, as well as comparison between IFRS and ASPE. So let's start with our intercompany investments. So intercompany investment is where one company invests in another company. Now, either that can happen through purchase of debt securities, or we can do the equity securities. Now, when the investor is purchasing an investment, we always look at the intention to determine how the accounting aspect of that investment should work. So for that, we try to determine whether the investment is that of a passive nature or a strategic nature. So passive is where the investor has just bought the investment with the intention of capital appreciation. For example, if someone is buying shares of a company for $10 a share, they are hoping to sell these shares in future for something more than what they bought the shares for. That is capital appreciation. With these investments, if you're looking at purchasing of shares, then you are possibly looking at making the dividend income in the future. And related to the debt investments, we are looking at interest income. Okay, so with the passive one, the intention is either that of a capital appreciation or to earn your dividend income or the interest income. The investment could either be in debt or equity, which is either common or your preferred shares. So the common type of companies that are looking to earn additional returns, such as your bank, insurance companies, pension funds, that is what your passive investment would look like. Accounting models, there are three accounting models that are available under passive investment. That is your cost or amortized cost model, fair value through net income, that is FVNI, and fair value through other comprehensive income, which is FVOCI model. If the investment is of a strategic nature where the investor is trying to exercise significant influence or control the company that they have invested in, then it becomes strategic in nature. The intention here is not just to earn the capital appreciation or the income, but the intention is to either influence the investee or to exercise control, okay? Exercise significant influence or to have control on their decision-making process. So here, that can only be achieved through equity common shares. So the companies that are looking to influence or control the other companies, there has to be an intention there. So the models that are available from the accounting perspective are fair value through net income and fair value through OCI models that are available. Equity method is for associates or your joint ventures, and consolidation is for your subsidiaries. So let's talk about our passive investments first. So with the passive investments, as we indicated, there are three different models available: amortized cost, fair value through net income, and fair value through OCI. So amortized cost model is used if the intention is to hold that investment to maturity. An amortized cost model can only be used for debt instruments. Equity instruments do not have a maturity date. That is why the fair value model is only available for debt and not for the equity. So under the amortized cost, then we are intending that the item or your debt instrument is going to be held to maturity. So at the time of acquisition, the asset or the investment is going to be recorded at the fair value. Typically, there are no transaction costs to worry about. Interest calculation is based on the effective interest rate amortization schedules, but ASPE also allows straight line amortization here. Any interest that is reported will hit the net income. Unrealized gains and losses are not applicable in this case because the investment is held till maturity and it is not revalued at the year end. So that's why there are no unrealized gains or losses. Any realized gains and losses are going to hit the net income. Under fair value through net income, this model can only be applied if the investment is short term. So if the business intends to sell this investment in the short term, which is in the 12 months time period, then we go with the fair value through net income approach. The initial recording of the investment will be at fair value, that becomes your cost. And once again, there are typically no transaction cost available. We will be using the effective interest rate for interest calculation. Your interest is going to be reported in net income. Any unrealized gains and losses are going to hit your net income as well as your realized gains and losses. One thing to keep in mind with the fair value models, as the name suggests they are fair value, these investments have to be revalued to fair value at the year end. So the question then is, where should that unrealized gain or loss be housed? Under net income, that unrealized gain or loss is going to hit the net income. Under FVOCI model, that gain or loss is going to be housed in OCI. So FVOCI model is only used for long-term investment, but these could be used. And FVOCI has to be an election that the businesses make. The initial acquisition, the investment will be recorded at the fair value, which is the same as your cost. There are no transaction costs here. Interest calculations will again use the effective interest rate amortization schedule. Interest income will hit your net income, but as we said earlier, any unrealized gains and losses, which are as a result of revaluing the investment to fair value at year end, is going to be housed in OCI. Under FVNI, that hits the net income. Any realized gains and losses, these are going to hit net income once they are realized and the investment is sold. That's where the gains and losses are realized. So then they will hit the net income, which is AOCI, that is recycled through net income. Looking at your passive investment for equity securities, under this one, we only have two models that are available, fair value through net income and fair value through OCI. The default model here is fair value through net income. But if the company likes, they can make an election, and that election is irrevocable. In that case, they can apply the fair value through OCI model. For both of these models, your initial acquisition is going to be recognized at fair value, which is the same as your cost. Now, if you have a transaction cost under fair value through net income, all the changes are going to hit your net income. So that transaction cost is going to be expensed. Whereas under fair value through OCI items, the transaction cost is going to be added to the investment cost. Any dividend income that is earned is going to hit the net income for both of these models, fair value through net income and fair value through OCI. And once again, the question is, when these investments are revalued to fair value at the year end, where should that gain or loss, the unrealized gain or loss, be housed? For fair value through net income, that unrealized gain or loss is going to hit the net income. For FVOCI, we will house that in OCI. Once your investment has been sold, that gain or loss that is realized is once again going to hit your net income under FV through NI model. Under FVOCI model, that item is going to be included in OCI. Then AOCI is not recycled. It could either be transferred to retained earnings or it's going to be left as it is. That is entirely a company's choice, but under this model, we are not going to recycle the realized gain or loss to affect the net income because this is an OCI transaction. Let's talk about our strategic investments here. Strategic investment is where one company has bought common shares of another company. Now, the quantitative threshold, when we are looking at the percent of shares purchased, we are looking at 20 to 50% of ownership. This is one indication to say that the investor has significant influence over the company for which they have bought the shares. If the significant influence exists, then the investee is called as the associate. It is just to indicate the relationship between two parties. So we look at the 20 to 50% ownership, that is the quantitative threshold. But sometimes the investments with below 20% ownership can also result in significant influence. So for that, we have to apply the qualitative criteria, such as is there representation on the board of directors, because that will um, indicate significant influence. You can influence the decision making, the policies. Is there any participation in policy making? Are there any material intercompany transactions between the two companies? What about the interchangeable managerial personnel? Provision for technical information. Are these companies using the technical information or sharing that information? So when we are looking to identify whether the significant influence exists or not, we are going to look at quantitative as well as qualitative criteria to make that determination. Once we determine that the significant influence exists, then we call the investee as the associate. Now, under IFRS and ASPE, there are different models that are available to account for significant influence, aka your investment in associates. Under IFRS, we call that as equity method. Under ASPE, we have the equity method, but we also have an alternative method, which is cost method, that's not available under IFRS. So how does this equity method work? When the initial investment is purchased, we are going to record the investment in associate as a debit. You will credit the cash account, but the investment in the associate account is going to be debited. That investment account is going to be adjusted based on the performance of the investee. So investor will take their proportionate share of investees' gains and or losses and book it onto their own books as if it affects them. In reality, they don't get any money, but this is how they are going to behave. By that same idea then, if and when the associate is paying dividend, that dividend is going to reduce the investment in associate account on the books of the investor. Now, if you have any shares of discontinued operations and other comprehensive income on the investee's books, they are going to be reported the same way on the investor's books, just as we would treat the income, losses, and dividend accounts. Now, unless there is impairment, your investment account is not going to be adjusted to fair value. At the point of disposition of the investment, both the investment account as well as the investment income account needs to be brought up to date before we take it off the books. So investment's carrying value is removed and any gain or loss at the point of disposition is going to be recognized in net income. Let's talk about our presentation and disclosure requirements. So for your investments without a significant influence or control, there are key presentation issues in the classification, which is whether these investments should be classified as current versus the long term. The key disclosures that needs to be included is the carrying amount of investment and any impaired investments, income statement effects, risk exposure, which is emphasized under IFRS, fair value information under IFRS, and reconciliation of opening and closing balances for the impairment accounts. IFRS generally tends to be more onerous when it comes to disclosure requirements as compared to ASPE. So your investment in associates are classified as non-current assets unless they are held for sale. Requirement for those using the equity method is investment category and accounting methods used, fair value of investments quoted in active market, separate disclosure of income from investment, and different year ends for associates. Under methods under equity, for ASPE, we have the carrying amount of investment in companies subjected to significant influence accounted for at cost, and the amount of investment income reported from these investments. Finally, looking at the comparison between IFRS and ASPE. So when it comes to measurement with no significant influence, which is your passive investments under IFRS and ASPE, all of the three models are available: amortized cost, fair value through net income, as well as fair value through OCI. Now, if you think of logically, ASPE does not have a concept of OCI. That is why automatically that model falls from ASPE. But the other two, which is your amortized cost and fair value through net income, they are going to be available on both the sides. So the only difference is ASPE does not have FVOCI. Your amortization method is using the effective interest rate under IFRS. We can apply the same idea under ASPE as well, but ASPE also gives an option of using straight line method. The impairment losses under IFRS use the expected loss model. Under ASPE, we look at incurred loss model. If you're looking at the significant influence under IFRS, we use the equity method. The same model is available under ASPE, but ASPE also has cost model and fair value through net income that's available. Subsidiaries under IFRS are used during follow the consolidation model. ASPE also has the consolidation, or they can use either the equity or the cost model, and also fair value through net income for subsidiaries. This concludes topic 13.